Hello, Wealth Builders. This is Angela Mitchell from DNA Financial Services, where we help you keep more of the money that you make. Welcome to the business edition of Coffee Table Conversation. Wanted to take a couple of minutes to speak to my entrepreneurs out there as we are now in the fourth quarter of 2019, and just want to give you a couple of tips to help you finish out the year strong. Number one, if you have not started doing so, now is a good time, although you should have been doing it from the beginning of the year, but if you have not, now is a good time to start organizing your financial documents for tax preparation. So if you haven't been tracking your revenues in and your expenses out, gathering that documentation up and organizing it. If you are really behind, I would recommend that if you at least do 1 month a week until you get caught up, that'll help you to have your documentation together for when it's time to meet with your tax preparer, so that you won't have to pay extra cost for your tax preparer to do that for you. Also, I wanted to go over a tax tip with you concerning, we want to finish the fourth quarter off strong. Maybe you've had a good year so far, but we want to finish off the fourth quarter even stronger. But one of the things as business owners that we're always concerned about is the tax bill that may be due as a result of the net profits that we have made. And one tool that entrepreneurs can use, if you don't already have, is being a business owner, is having what is called a solo 401k. And for those of you who may not be familiar with the solo 401k, it is similar to the 401k that you would have had when you were working for an employer, except for it is specifically set up for entrepreneurs that may perhaps be a one-man shop, meaning you are the only employee. And you can start off with what is called the solo 401k, and then if you get to the place where you're actually hiring employees, then you would go ahead and switch to what is called the traditional 401k. So with the solo 401k, if you are under age 50, and this is the beauty of this particular product, when you are trying to reduce your tax liability, you can contribute up to $19,000 as an employee. You can contribute up to $19,000. Now, if you are over 50, you can contribute up to $25,000. And so, and if you are an S corporation, you can do what is called a profit share or an employee match. And so what you can do is contribute up to, as an employee, as an employer, I should say, up to 25% match. And so, but not to exceed in total $56,000 for employees under the age of 50. If you're over 50, you can contribute a maximum of $62,000. So let me kind of step back a little bit, because I know I said a lot there. So we have two contribution types. The contribution as an employee, and so your contribution as an employee is up to $19,000 if you're under the age 50, up to $25,000 if you are 50 and over. As an employer, you can contribute up to 25% of your employee's contribution, but not going over, with a maximum contribution of $56,000 if you are under age 50, and no more than $62,000 if you are 50 and over. Okay, so when you look at that, and this is all, predicated on the type of revenue or the type of net profits you made for the end of the year, how much you would want to take advantage of those contribution levels. Okay, but those are your maximums that you can do. And with the solo 401k, any contributions that you make to that particular plan, be it you choose it if you're contributing to what is called a traditional type of solo 401k, those contributions are tax deductible. And if you are an S corporation and you have the extra layer of being able to also match what your employees are paying into the 401k, which allows you to be able to deduct those contributions. So that's a great strategy that you can use to reduce your tax liability. Now, one of the things that I like to say about that, if you don't already have a 401k in place, you would have to have that in place no later than December 31st of 2019 in order to take advantage of that being one of your tax reduction strategies. Now, you have up until your tax filing date to make contributions. So if you are an LLC that is being taxed as a sole proprietor, you have all the way up until April 15th to make your contributions. If you are an S corporation, you have all the way up until March 15th to make your contributions. And I might add that if you are filing an extension, then you have up into your extension expiration date to make those contributions as well. So a great way to reduce your tax liability at the end of the year, and certainly there are some additional strategies that can be applied as well. But today I wanted to go over that one with you, and that is of a solo 401k, or you could do just a traditional IRA if you wanted to, or a Roth IRA. Okay. Now, with the traditional IRA, you are limited in terms of what you can contribute on a yearly basis. For 2019, if you are under the age of 50, you can contribute up to $6,000. And if you are 50 and over, they have what is called the catch-up plan, and you can contribute $7,000. And so that would be with your traditional IRA. And then that would be also a tax deduction for you as well. With the Roth IRA, you do not get a tax deduction with that, but that is because you are using monies that are already taxed. And when you contribute to that, when you get ready to start taking your withdrawals from that particular plan, it is tax-free. So you don't have to pay taxes on that when you start taking the withdrawals, as opposed to with the traditional IRA. When you begin to take withdrawals on that, it will be taxed at your current tax rate. So just a couple of things I'd like for you to keep in mind in preparing for the close of the year. So thank you for joining us for today's business edition of Coffee Table Conversation. Remember, you can find us on Facebook at DNA Financial Services, or my YouTube channel at debtnotallowed.com. Thank you for joining, and remember, debt is not in your DNA. Have a good day.